All right, we have a great journalist to break down what he thinks of exactly what the federal government is doing and explain it in plain terms. And also, he has a great piece. This is Matthew Zeitlin that we're going to bring in with Grid News. It's a great piece explaining how exactly we got here, what the promise of Dodd-Frank financial reform was, and how it is that now we're, 15 years down the road and we're doing bailouts once again. So how did that ultimately fail? So let's get to it. Matthew Zeitlin, thanks for joining us.
Good to see you, man.
Thanks for having me. Good morning.
Yeah, of course. So we did our best to explain what action the U.S. government is taking, but I would love for you to just explain in the plainest terms possible what has just been decided.
Yeah, so there's two parts of this. The first is that any deposit holder in Signature Bank or Silicon Valley Bank, as of this morning, has full access to any amount of money they deposited in those two institutions, even if it's above $250,000, which is the FDIC insurance limit. There was a lot of doubt about this over the weekend, but that is now totally, it's like those money claims are good. You have access to any money over $250,000. The second thing is arguably more expansive, but a little harder to understand. Any bank now can go to the Fed and post assets they have, treasury bonds and agency mortgage-backed securities, and get money back. It's a lending operation. It's essentially a way to take their current long-term assets and temporarily for a year or so, turn them into cash. The idea here is that if any bank is coming under pressure from depositors asking for withdrawals, they can have more liquidity, which means that they have more cash at hand to process those withdrawals. But obviously the idea here is to make it seem like banks that are solvent today will still be solvent tomorrow, and that if you're a depositor, you don't have to get panicky like what happened with Silicon Valley Bank last week.
Right. And so, Matthew, one of the things we've been talking about is that this sets a tremendous precedent now for basically all banks in the United States. They now, effectively, the U.S. government is guaranteeing the deposits of all $9 trillion in banks across the U.S. What does that mean for the banking system as a whole? What are the perverse incentives, the moral hazard, if you wish?
So the main thing this does is that any role that depositors have in ensuring bank safety and soundness and security has been wiped out. Pretty much what the government here is saying is that all depositors are like they have insured deposits, even though the system is only funds itself for insurance, these premium claims that banks have to pay the FDIC for deposits up to $250,000. So that's a really big deal. And the second thing is that the government is essentially saying that if you're solvent today, you're going to be solvent tomorrow. And that's even though the federal government won't be necessarily quote unquote spending money on these lending operations in all likelihood, it is a massive subsidy to the kind of regional banking sector.
Yes.
So it is a big deal because the banks have not had to give anything up in exchange for this. There's no added regulation or anything like that. I mean, typically that's the deal. It's if you want to offer FDIC insured deposits, you get overseen, supervised by the FDIC. And that level of protection has really gone up, but the obligations that banks have to the system as a whole has not gone up in turn.
Mm-hmm. Yeah, talk about that piece a little bit more. Let's go ahead and put this tweet that Matthew had up on the screen, because as you were pointing to, they have paid into the FDIC, to this insurance fund, with funds sufficient to, insure $250,000, the first $250,000 of their deposits. But they actually, when the FDIC right here hiked its assessment rate for the deposit insurance fund last year, bank trade groups opposed it, saying that it was, quote, a preemptive strike against a non-existent threat. Clearly, they were incorrect about that. Now, my understanding is the FDIC went ahead and hiked its assessment rate anyway. However, it's nowhere near sufficient what they've been paying in order to backstop all of the uninsured deposits across the country. So I know that the government is going to great lengths as, the taxpayers' funds aren't on the hook, this is completely funded by Wall Street payments, et cetera. But if we're de facto backstopping the entirety of the banking system and all the deposits held therein, doesn't it, sort of beg our belief to imagine that taxpayer funds are not at least sort of on the hook, even if they may not be directly spent in any way?
Yeah, I mean, I think sometimes just looking at kind of the flow of funds from, the Treasury to the banks doesn't really capture the value of what's been transacted here. I mean, like, this is obviously very, very valuable to banks and bank depositors, even if literally no money is actually spent. Like, the deposit fund could stay at $125 billion. And yet a huge amount of value has been given over to depositors. You have to remember lenders to banks, and then the banks themselves, which are now in a kind of more secure situation. So I think what's happening here is that after 2008, there was a huge political backlash to bailouts. And the way that was captured in the post-2008 laws and in what regulators want to do is that they never want to be in a situation where they're seen as be giving taxpayer money directly to insolvent institutions or huge lending facilities to insolvent institutions. So what I think we saw Sunday night was a 2008 style action, but kind of drawn within the lines of what regulators interpreted made the public angry about, things like TARP and support for AIG and support for things like Citigroup and stuff, where they felt like they're rescuing failed or failing institutions and the management wasn't treated harshly enough. Shareholders still survived. So if you look at it from kind of the government perspective, what they're saying is, look, the SVB shareholders went to zero. Their management has gotten fired. There's not really the taxpayer money on the line because it's raised from the banks. But, a huge amount of value has been transferred to the entire banking sector from ultimately the public, even if it's not so much public money, but it's kind of like public authority that comes from all of us to them. So, yeah, it's like kind of this whether or not it's a bailout's kind of a semantic issue, but it's like a huge amount of support.
Right. It's obviously a bailout. Andrew Ross Sorkin says it's a bailout, right? Okay.
Yes.
So let's go ahead and put this up there on the screen. You wrote a good piece, how 2008 reforms did and didn't prepare us for the Silicon Valley Bank collapse. Can you just roll through that? I think a lot of us, I especially did have questions. I was like, hey, when our breaking news segment here, I said, this is going to be a big test for Dodd-Frank. As I understand it, they weren't even on the troubled bank list. So how did regulators miss this? How did the Dodd-Frank architecture respond?
Yeah. So this is really important. Almost as soon as Dodd-Frank was passed in 2010 and kind of the rules were written over the next few years, banks of around Silicon Valley Bank's size, so these would be like large regional banks that are still substantially smaller than JP Morgan's of the world. These are banks with around $50 billion to $250 billion in assets. And at the time, Silicon Valley Bank had $40 billion, and now they had last week over $200 billion. What they were arguing is that all these rules that were implemented on the largest banks to make them kind of more resilient to crisis, and then make it so that if they failed, they had this kind of special process such that the entire system wouldn't collapse around them. Those rules were being applied to this size of bank, and they were very, very angry about it. And the argument they were making is that they were lower risk institutions and you're too big to fail banks, and two, that they could be resolved through the normal FDIC process. I mean, the CEO of Silicon Valley Bank, when the bank was 1/5 the size as it was last week, was testifying to Congress to this effect. Regional banks are quite powerful because they're kind of locally rooted, and so legislatures really listen to them. Anyway, so in 2018, the Trump administration, with the support of a smattering of moderate Democrats, passes this partial rollback of Dodd-Frank, where it's really aimed at kind of the Silicon Valley Bank and smaller institutions. And a big thing that they did was say that they didn't necessarily need to maintain this thing called a liquidity coverage ratio, basically maintaining kind of high quality liquid assets, stuff that can be turned into cash super duper quickly in case there's like a bank run going on, more or less, and that they didn't have to do as much planning for their failure. Now, whether those rules would have prevented this like full on run on a bank that we saw last week is questionable, but the central intuition behind this deregulation that these banks were less risky than the JP Morgans of the world, and that their failure to be resolved through the normal FDIC process turns out to have been completely wrong.
Got it.
I think that's very well said. Let me ask, this is an impossible question to answer, but I would love to hear you muse on it. What if they did just follow the normal process for resolving the situation, which is, okay, $250,000 insured, backstopped by the FDIC. You could get that on Monday, no problem. The rest of the assets of the bank are sold off and used to make depositors as whole as possible. Then back of the envelope calculations I saw was that they'd probably take like a 10% haircut. They'd get about 90% of their funds, even the ones that were uninsured. If we went that alternative path, what do you think would have happened?
I think there would have been a lot of there's two issues. One is that the worry was that there would be companies that had payroll issues because they were using Silicon Valley Bank as like a transacting bank just to kind of move money from their business to their customers and clients and stuff. Now, I don't know if that would have really happened because if everyone was getting 50% on Monday or Tuesday, they probably could have made it work. The worry was that other banks that had a similar kind of risk profile to Silicon Valley Bank would also be under tremendous pressure, that people would withdraw from them and then put their money into kind of bigger, safer banks, the JP Morgans of the world, and it would kind of be this cascade of bank runs. The issue is that like it's just so hard to know whether or not that would have happened, but it was definitely a worry. I think what's really interesting is that it seems like the federal regulators, sorry about that, were not able to find a buyer for the bank, which is ideally what they try to do, is that over the weekend, they find someone to take over the whole thing. This is what happened with Washington Mutual when it failed in 2008. It was a $300 billion bank, but they were able to kind of tie it up with JP Morgan. That did not really seem to be in the offing over the weekend, or else they would have done it because it's kind of the easiest way to do this, which I does think indicate that there is kind of more pressure on the system than in a typical bank failure situation.
Mm-hmm.
And finally, Matthew, I'd love to get from you, based on the actions that the government just took in this non-bailout bailout, we've effectively not only backstopped the entirety of, deposits insured and uninsured across the country, we also have effectively, especially with, including Signature Bank in this, effectively deemed all banks too big to fail. How should that be reflected in a different policy approach? Because I think the thing you pointed out at the beginning, which is so important, is that they're being given tremendous value and not being asked to change anything at this point. Now we expect President Biden to speak today. We'll see what he has to say. But how should our banking architecture reflect this new reality?
I think the first thing that we'll see happen is that there's going to be a big push to kind of re-examine this 2018 Dodd-Frank rollback, and this idea that these medium-sized banks are not systemic threats is obviously just not true. We've kind of done a dry run of this, and we found out they are. And then I think we're going to see bigger questions, where a world in which deposits are assumed to kind of always be safe, and then it's like, what is the role of a banking institution? Because they're essentially getting this subsidy from the government, not so much in being kind of this extraordinary action that happened the weekend, but they're getting the right to essentially create money-like claims, and that they're getting this indefinite subsidy in order to do so. And I think it's really opened people up to this idea that, like, why can't the government do this to some extent? Now, are we going to get some kind of postal banking or kind of basic Fed banking for everyone overnight? No, but I think it's really kind of opened people up to the possibilities that, the government and the banking system are really kind of completely entangled with each other in this very, very basic level. And then once you realize that, it kind of opens up the field of possibilities. So
right.
People will be talking about this. Whether it turns into legislation is obviously very hard to tell.
Yeah, I mean, if the taxpayer is ultimately, and the U.S. government ultimately 100% on the hook, why are they getting to benefit from all the gains while the taxpayer is backstopping all the losses? It ends up being a sort of an insane situation that's just been revealed.
Yep. Absolutely. Matt, it was really nice talking to you. Go ahead and check out, we'll put a link to his Twitter and to link to the story and all of that in the description. Appreciate you joining us, man.
Thank you.
Thanks so much. Had a great time.
Hey guys, ready or not, 2024 is fully upon us now, and Saagar and I have been brainstorming ways that we can really up our game for this critical election.
Yeah, we rely on our premium subs to expand our coverage, to add staff, to upgrade the studio. We just want to give you the best independent coverage of this election, which is possible. So if you can help us out, become a premium subscriber today, breakingpoints.com, or the link is down here in the description video. It really means the world to us, and if you like what we're all about, this is the best possible way to keep us 100% independent, working only for you.